Hi, good morning, everyone. Thank you so much for joining our Phillip Security Research 11 o'clock Monday morning calls. Today we have a couple of US SG results and updates, as well as the usual Singapore weekly and technical polls. For disclaimer, the information provided in this seminar is solely for educational purposes and it should not be considered as financial advice. Please seek advice from a financial advisor before making any investment decision. Next, I'll pass the time to Fahmi for maximum monthly. Thank you.
Thank you, Serena. Hi, everyone. For Magnificent 7 monthly for April update, the first quarter earnings beat power sharp rebound. Magnificent 7 stocks rebounded sharply by 16% in April, outperformed the S&P 500, which grew 10%. The rally was driven by the US-Iran ceasefire, easing oil price concern, strong first quarter earnings beats across the hyperscalers, and renewed investor confidence in the AI monetization. Google led the gain with 33% monthly basis up, and on the accelerating Google Cloud growth of 63%, followed by Amazon, which was up by 30%, which is the strongest AWS growth in the 13 quarters. Next slide, please. For Tesla, Tesla released the first quarter 2026 production and delivery figures on the 2nd April. The vehicles produced was up by 13% yearly, while the vehicles delivered was up by 6% yearly. But the delivery meets the consensus estimate by 7.6 thousand. On 22nd April, Tesla reported the first quarter 2026 earnings. Revenue was 22 billion, which was up by 16% year-over-year, and the non-GAAP earning per share was 41 cents, both beating the consensus. China sales remain under pressure. Tesla sold about 26,000 EV in China for April, which is a 10% yearly decline. Ends up, Tesla market share in April was at 5.6%, which is lower than the previous month, which is also the lowest in the 29 months. Tesla continued to face headwinds from BYD's aggressive pricing and an expanding range of competitive Chinese EV models. Moving on to the next, their business, which is TerraFab. On 22nd April, Musk clarified that the prototype research fab at Giga Texas carries $3 billion investment, and this project would require 20 to 25 billion to move further the project. But this amount is not yet incorporated into the Tesla financial year 2026 capital expenditure plan, which is already at a $20 billion record high. We view TerraFab as a multi-year, capital-intensive, and also come with a significant execution risk. For our comment, the valuation now is extremely stretched at 320 times of PE due to the non-auto related expectation such as robotaxi, humanoid robot, and also the newly chip manufacturing. We continue to believe that the significant revenue contribution from this initiative is still 5 years away or more than that, while their core EV demand remains under structural pressure. We continue to see multiple headwinds from the removal of the $7,500 EV tax credit, intense Chinese competition, and tariff. As such, we remain cautious about Tesla and maintain our sell recommendation at a target price of $250. Next slide, please. Next is on NVIDIA. For the first update, hyperscalers increased their 2026 capital expenditure guidance. So the increase in guidance for capital expenditure from the hyperscalers would definitely benefit NVIDIA in the long run. Meta increased their 2026 capital expenditure guidance by 8%. Google did the same. They nudged up their capex guidance for the year to $185 billion from $180 billion previously. Amazon, on the other hand, maintained the $200 billion guidance. In total, hyperscalers guided 2026 capex to surge by 89% yearly to $710 billion. NVIDIA and IRENE partner to deploy up to 5 gigawatt of AI infrastructure. The deployments are expected to focus on IRENE's Sweetwater campus in Texas, which would serve as the flagship to deployment of NVIDIA DSX architecture. From this deal, IRENE granted NVIDIA 5-year rights to buy up to 30 million shares. For the last update, NVIDIA and Corning announced a multi-year commercial and technology partnership. Cornings provide fiber optic, co-packaged optics, and high-density optical cabling that supports NVIDIA Quantum X and Spectrum X networking platform. For our comment, much of the hyperscalers' capital expenditure is expected to be spent on expanding AI compute and cloud capacity, which is expected to benefit NVIDIA, which has 90% market share in the GPU space. We believe NVIDIA is actively securing its supply chain in networking, data center hardware, and chip design. NVIDIA previously guided at least $1 trillion Blackwell and Rubin revenue through 2027, which should represent a giga growth of 127% yearly from 2025. To support such fulfillment, NVIDIA is taking necessary steps to expand capacity while maintaining gross margin of above 70%. Next slide, please. Next is on Microsoft. They released their third quarter earnings. The group revenue grew by 18% year over year, which is 2% ahead of the guidance, which is supported by the Fairwater data center coming online 6 weeks earlier than scheduled. The Cloud Azure grew 40%, which is above than 33% in the same quarter last year. And their AI-related business exceeded $37 billion annualized recurring revenue, which was up 1.3 times yearly. Microsoft also ends the exclusive right to OpenAI models and IP. This allows OpenAI to partner with the other cloud providers such as AWS to meet the growing computing needs and also develop products. In return, Microsoft no longer have to pay revenue share from the reselling OpenAI products in its cloud, but still remain the primary cloud provider. And then they also make another multi-year, multi-billion investments. Microsoft in total pledged about $34 billion to build overseas cloud and AI infrastructure. So they make investment in Singapore for $5.5 billion and in Japan $10 billion, partner with the other local companies, and also 18 million in Australia. Lastly, Microsoft raised their hardware products prices amid the memory crunch for their Microsoft. This happened to their Microsoft Surface, which is their first-party hardware line product, for example, like laptop, desktop, and accessories. So the company is passing on the higher chip cost to the consumer. For example, one of the product is called Surface Pro, and this price is up by 31% since the product launched last year. And they also increased the price for the older models as well. Across the competitors, companies like Dell, Lenovo, HP, and Apple also lifted their prices from this higher price in memory prices. For our comment, Microsoft share rose about 10% monthly basis, but remained 24% below the July peak of $540 because of the higher capex, needed margin pressure, and AI disruption. Also because of the slowing seed crude concerns. We downgraded to accumulate recommendation from high with a lower target price of $485 from previously $540 due to the higher capital expenditure, which is $190 billion expected in 2026. However, we expect a step up in growth as the new data centers ramp up, supported by the high commercial backlog, which is at $627 billion, which is 1.9 times of the group revenue last year. And we are also seeing healthy 26% yearly enterprise growth for the RPO. That is all from me. I will pass over to Serena for her presentation. Thank you.
Thank you, Fahmi. Hello, everyone. I'll be presenting Alphabet and Meta. Let's start with Alphabet first. The company deliver a very strong performance for the first quarter to 6. The search advertising revenue up 19% year on year to $60.4 billion. And the cloud segment also grew 63% year on year to $20 billion because of the very robust demand for enterprise AI solution. And Another update for Alphabet is that the company mentions that they will invest up to $40 billion to Anthropic in order to support the company expansion in compute capacity. So besides giving out the cash, I mean, Google Cloud will also provide 5 gigawatts of computing power to Anthropic over the next 5 years. So moving forward, we continue to expect the company's vertically integrated full stack AI models, which includes TPU silicons, AI infrastructure like data center, and also Gemini multimodal models remain the primary catalyst for sustainable profitability for Alphabet. And we also view the Alphabet investment in Anthropic positively because with the Anthropic growth and also the potential IPO this year, is likely to drive the further demand for Google Cloud infrastructure and also TPU. This why for Alphabet, we have a target price of $450 with the accumulated rating. And next, for Meta, the ad revenue increased 33% year-on-year to $55 billion. This is driven by the higher user engagement and also strong advertiser demand. But the company guided a higher CapEx for financial year 26 to a range of $125 billion to $145 billion. As for Manus AI, Meta currently faces some scrutiny over the acquisition by the Chinese regulator because the company was ordered to unwind the $2 billion deal, even though the deal was announced 4 months ago and they already have some integration going on. So for the result, at the moment, we still believe the fundamental remains quite intact, but we do expect because of the kickbacks, it will continue to weigh on the share price, given that Meta is lack of other revenue stream for monetization beyond advertising. Part of the reason is because they don't really have the cloud business to monetize it for their excess compute capacity. And we also slightly cautious about the potential reversal or entirely blockage of Manus deal because we think it will limit Meta access to specialized AI talent and capabilities. And because of this reversal, they might have to more reliance on in-house development. It would potentially slowing down the progress in agentic and commerce related development. So for Meta, we have a target price of $795. Yeah. And that's all from me. I'll pass the time to Helena. Thanks very much.
Thank you, Serena. I'll move on to Apple. So Apple's second quarter results were exceeding expectation. Their revenue grew 17% year-on-year, which is considered very high because they've been having very flat growth over the years. iPhone grew 22%. The China market also did really well. It grew 28%. They're seeing very strong demand, not just for their iPhone 17, it's also for a MacBook, especially MacBook Neo, due to the attractive pricing. So both currently is facing a supply constraint. On the other hand, they're still trying to move the making of the iPhone out of China. So they aim to manufacture the majority of the iPhones sold in the US from India instead by the end of 2026. Overall, we're seeing very strong near-term momentum, supported by the strong product cycle. However, it appears very primarily by hardware improvement rather than AI features. So we think that kind of limit the sustainability of the current strengths over the longer term. On the AI side, Apple's collaboration with Google Gemini is probably the biggest push factor, but near-term monetization impact from this AI collaboration remains a question mark. At the same time, because of the rising memory costs and elevated operating expenses, it's likely to weigh on the margins. So as such, remain cautious on Apple. We have a neutral rating with a target price of $280. Moving on to the next slide, will be Amazon. So Amazon's earnings were in line with expectation. Their revenue grew 18%. AWS seeing very strong growth. It grew 28%, which is their fastest growth in 15th quarter. They've guided a continued elevated CapEx spend, but the guidance remained unchanged. It was still $200 billion for FY26. And also we have OpenAI coming up to Amazon. So they added Codex and OpenAI's latest AI model onto their Bedrock. They've also have continued collaboration with Anthropic. They previously already invested $8 billion US. Now they are going to invest $5 billion more. In return, Anthropic has committed to spend more than $100 billion US over the next decade on AWS infrastructure. They will also secure up 5 gigawatt of AWS capacity to train and operate its AI models. And Amazon also secured major partnership with its in-house chips. Its latest customer is Meta Platform. So under the new agreement, Meta plans to deploy tens of millions of AWS Graviton processors to support its Meta AI workload. So we really view this customer silicon as an increasingly competitive advantage for Amazon. Amazon right now is ranked number 3 in the data center chip business, and currently all the feedback we're getting is both their Trainium and Graviton have better price performance when you compare it to alternatives. Demand is also very healthy. And we think the best thing about it is these in-house chips, they can potentially save Amazon's own capex. It can save tens of billions of dollars of annual capex over time. So that further strengthens AWS cost efficiency and price competitiveness and position it for the long-term leadership in the global data center market. So overall, we have accumulated rating with a target price of $280 US. Now I'll pass it back to Fahmi to close it off.
Thank you, Elena. So just to close off the Magnificent Seven, we maintain overweight on the Magnificent Seven. The April rebound has lifted valuations to the 36 times for forward PE, but the re-rating reflects strong first quarter 2026 earnings, robust cloud and AI momentum, and easing geopolitical risk. The net cash balance sheet, robust free cash flow, and long-term energy agreements continue to insulate the group from the cost pressure, while the accelerating AI monetization underpins earnings growth and that outpace the broader market. Excluding Tesla, Magnificent Seven earnings will continue to outpace S&P 500 and Nasdaq 100, anchored by non-cyclical demand and the US AI action plan. That is all for Magnificent Seven. Moving on to their stocks result. Next slide, please. So ABNB released their first quarter 2026 results, modest booking and ADR growth. Next slide, please. So the first quarter result met our expectation. The revenue and PATMI were at 20% and 5% of our full year forecast. We expect the PATMI to be second half of the year weighted, driven by the summer travel demand and operating leverage. For the result, the revenue grew about 18% year-over-year, driven by booking volumes up by 9% and also the average daily rates up by 9%. For the positive, the booking volume was up by 9% increase, despite the higher cancellation across the Europe, Middle East, and Africa region due to the Middle East conflict. Regionally, Latin America and Asia Pacific saw high teens growth. Customers are booking further in advance across all regions, driven by the reserve now and pay later offerings. Also, the average daily rates, the ADR expanded by 9% yearly to $187 US, benefiting from the FX tailwinds and strength in the North America. The North America, which is ABNB largest business region, rose about 7%, driven by price appreciation, and also growth in the short-term stays, which outpaced the long-term stays. Short-term stays rate is higher than the long-term stays. For the negative, we are seeing headwind from the Middle East conflict. The seat book expected for the next quarter, which is the second quarter, are expected to slow slightly due to the higher booking cancellation in the Europe, Middle East, and Africa region. We expect this volatility to persist in the near term, though bookings could stabilize if regional conditions improve. For the outlook, we expect the full year group revenue to rise by 13%, driven by major events like the 2026 FIFA World Cup in the North America, and also the broader rollout of the initiatives such as Reserve Now, Pay Later, simplified fees, and updated cancellation policies globally. North America would remain as the key drivers as it makes the majority of the revenue. And their new business venture, which is ABNB services, is expected to stay immaterial over the next 3 to 5 years due to the slow scaling. For the valuation, we downgrade to neutral from accumulate with a lower target price of $136 from previously $138 following the recent share price performance and higher operating expenses, which reflects stronger investment for their ABNB services policy initiative. The new business need to ramp up in expenditure. We remain still like ABNB because of the light asset platform, which is scalable, which would require low capital if to do so, and also because of the strong host case network effect, which means that higher host count would increase higher guest count and as well as vice versa. Before I end up my session, please be informed that some of our analysts are not around, which is Paul, Ben, Glenn, as well as Ziggy. They are on leave. So some of your questions we might not be able to answer because they are not around, I guess. Yeah. Pass over to Helena for her presentation. Thank you.
Thank you, Fahmi. Move on to C Limited. So C Limited also released their earnings last week, and we see the theme was 2026 is going to be an investment year for them. Next slide, please. So the revenue was in line with expectation. PEMI underperformed slightly due to them sharply increasing their investment in Shopee. Their sales and marketing expense grew 52% year on year. So another strong quarter for them. We're seeing all-rounded growth for Shopee, for Money, and gaming as well. They all deliver remarkable growth, 44%, 40%, and 58% year on year, respectively. So I'll talk about Shopee first. So they're really ramping up the investment this year. So they have similar GMV growth when you compare to the previous quarters, but this year their sales and marketing expense rise 52% year on year compared to around 30% in the previous quarters. So the ramp up investment, the main focus is on Shopee VIP subscribers, live streaming, and also improvement in logistics. The management maintained their FY26 guidance of around 25% GMV growth, but they really illustrated several times that 2026 will be the investment year for them to try to further strengthen Shopee's long-term competitive moat. Moving on to Money. Money grows very stable with also very stable NPL. Their loan principal grows 71% year on year. They're trying to expand into more affluent borrowers with higher credit limit and longer loan tenures. They're also trying to expand their off-Shopee lending penetration. They're pushing for higher ticket consumption scenarios. Their 90-day NPL ratio remains stable at 1.1%. So this is very close to high-quality traditional bank levels. And we believe this is where their competitive advantage came from because they have a very rich e-commerce ecosystem data, which enables them to have very efficient underwriting and better risk assessment and lower customer acquisition costs when you compare it to many standalone fintech lenders. Moving on to gaming. Gaming delivered its strongest quarter since FY21. Driven by continued strength in Free Fire. So they continue to execute very successful global IP partnership. The reason one was the Jujutsu collaboration, which is very popular among the users. They're also seeing other games like Arena of Valor also achieved record quarterly bookings in its 10 years of operation. And they mentioned that it's not going to be a one-off. They do expect 2026 to be a record year for this particular game. So overall, we increased our FY26 and 27 sales and marketing expense assumption to around 56% of the operating expense to account for the increasing investment. Overall, we still maintain our buy recommendation. We're seeing they're in a very strong competitive position with our unchanged target price of $170. That's all from me. I'll pass the time to Serena. Thanks.
Thanks, Helena. Good morning, everyone. I will be presenting AppLovin first quarter 26 result, in which I title Robust Ad Momentum Ahead of Exxon Global Launch. Yep. So overall, the earnings are within our expectation. The revenue partly were at 25% of our financial year 26 forecast. The first quarter revenue rose 59% year on year to $1.84 billion, and PATMI spiked 109% year on year to $1.21 billion. These are driven by the ongoing technology improvement across the core gaming business and also expanding consumer vertical. We continue to see gaming remains the key revenue contributor for AppLovin ad business because this segment currently benefits from a shift towards hybrid monetization, which includes in-app purchase plus advertising by the game developers. As they are more in-app purchase only games, they started to get involved in advertising. And as for the consumer vertical, it continued to scale even though they just launched it 1.5 years ago. Currently, they see much spending is up around like 25% compared to January, and advertisers spending in April is actually reaching a record monthly high. So since AppLovin currently is referral based, the company they announced it they'll proceed to open up Exxon platform to global advertiser in June 2026, so that we expect there will be a continuation of expansion for consumer vertical because there will be a broader advertiser base. And the second positive is that continue to see AppLovin to show a very strong financial standing. Like I mentioned, the net income by 109% year on year to $1.21 billion is supported by a very strong revenue growth, but also almost a 400 basis point expansion in adjusted EBITDA margin. Is currently at the record high of 85%. The free cash flow also remain quite strong. It's rising around like 58% year on year to $1.3 billion. But the management expect the quarterly free cash flow will be softened in the second and third quarter because of the cash tax payment, but they would expecting it will start to normalize to around like 75% of EBITDA for financial year 26. And in terms of the guidance, AppLovin guided a second quarter revenue to be in the range of $1.915 billion to $1.945 billion. It implies a year-on-year growth of 52% to 55%. And they also expect the adjusted EBITDA to be in the range of $1.615 billion to $1.645 billion. And they continue to target the adjusted EBITDA margin in the range of 84 to 85%. So for AppLovin, we maintain a buy recommendation. We also increase our target price to $635. We increased the financial year 26 revenue and PATMI by 3%, 4% respectively, because of three main reasons. The first one, that there is a sustained demand from the gaming segment. And secondly is that we do expect accelerating contribution from a consumer vertical. And the third catalyst would be the upcoming global rollout of the Exxon platform in June 2026. We expect this open up to the global advertiser will further support the revenue growth. So that's why we increased the target price to $635. Yep. And that's all from me. I'll pass the time to Darren. Thanks very much.
Yeah, thanks, Serena. Yeah, so I'll run through some Prime US REIT results. So for Prime US REIT, there was a steady growth in portfolio occupancy. Yeah, so it's been creeping up since 1 year ago, every quarter on quarter. Yeah, exactly. So for the business update, only MPI and DI were disclosed. So those were in line with expectation. So MPI is down 2%, DI is down 22%, but that's mainly from the fact that leases expired, and when they re-sign the new leases, there's a rent-free period. So as a result, the DI is down 22%. But going forward, we expect that to slowly creep up as occupancy and the cash rentals start to come in. Yeah, so for the positives is that the portfolio fundamentals continues to improve. So we think it has already bottomed already. So now it's only upwards from here. Occupancy is on an uptrend, so now it's at 83.1%. So 1 year ago was at 78.9%. And in the first quarter, about 100K leases were secured in at about 4% positive rent reversion. So we think that is some good numbers. But for Prime US REIT, the negative is that their cost of debt is expected to edge up this year, and that's mainly because 50% of hedges expires in June 2026. So currently the cost of debt is at 5.4%. It was stable quarter on quarter. Yeah, but we still think the cost of debt, even though you'll edge up, but you'll remain below 6% for this year. Yeah, the leverage 45.2% and ICR 1.6%, slightly elevated, but still within MS leverage limits. Yeah, so for the outlook is that the US office market is still seeing flight to quality and leasing momentum is still strong. So according to JLL, the US market saw leasing activity up 7.6% year on year, and transaction volumes also increased by 40%. So it really spiked. And for Prime specifically is that in their submarkets there is limited new supply, so they benefit from that, from limited supply and quite strong demand. But the key highlight for them is that currently only about 73% of their occupancy is contributing cash rentals. So upcoming, there's another about 11% of occupancy, or 460,000 square foot of occupancy that is sort of staggered to progressively commence cash contribution from third quarter. So that will continue to improve, and we expect occupancy to exceed 85% by the end of year end, so continue to trend upwards. Yeah, so assuming a 65% payout ratio, the forward dividend yield is 7.2%, so we think that's attractive. Prime is also trading at a very steep discount still, 0.34 times price to NAV, so we think there is a lot of potential for capital appreciation, especially as the US market, office market recovers. Yeah, so no change to our TP and buy recommendation. Yeah, next slide, please. Yeah, so for United Hampshire, the portfolio is really defensive. So over 90% defensive retail, strip center, so defensive retail portfolio underpins stability. Yeah, next slide, please. Yeah, so for United Hampshire, their results were in line with expectations. So gross revenue is up 8.7%, DI is up 10%. That's mainly from the contributions from the acquisitions of Dover Marketplace and Wallingford Fair Shopping Centre. So MPI is up about 12.7%. Yeah, for the positives is that they had the grocery and necessity portfolio occupancy stable quarter on quarter at 97.7%. So that's very high. Self-storage occupancy increased 55 basis points to 89.2%. So going forward, we think this self-storage properties will continue to improve in occupancy at higher rents as well, especially since now the self-storage side will continue to benefit from the peak spring leasing season, which has already started. Yeah, so for the first quarter, they had about 164 square foot of leases secured. So this was at a positive rent reversion. We think it's at low single digit, so in line with the rest of the portfolio. And for the cost of debt, it continues to trend down for United Hampshire. So they do not have any refinancing requirements until 2028 as well. So their all-in cost of debt declined from 5.21% in first quarter 2025, so that's last year, and continues to trickle down, and now it's, or rather continues to decline over time, and now it's at 4.91%. So they have 70% of their debt on fixed rate. Yeah, the gearing also is healthy, 41%, ICR also healthy. Yeah, so for United Hampshire, there is tight supply and muted new supply for our strip centers. So over the next 4 years, there's only about 0.3% of new supply annually. And like I mentioned, the self-storage side will continue to benefit from the peak spring leasing season as people start shifting and moving house. Yeah, so the United Hampshire, they continue to look source for yield accretive acquisitions in strip centers. So that strip centers paying a yield of about 6.5% on average. So that is, you can still get a good yield spread from that. The cost of that about 3+%. Yeah, so there's a still good positive carry. Yeah, and for United Hampshire, is really a defensive and resilient portfolio that high occupancy, grocery and necessity 97%, high tenant retention rate, and only 2% of leases expiring in this year, 2026, and 5.2% of leases expiring in 2027. So it is a very resilient long WALE, 8 years. So all this underpins portfolio stability. So in the meantime, United Hampshire is paying a very healthy yield of 8.6%. So we do think that's attractive. So we maintain our buy call and our DDM TP of 69 cents. Yeah, next slide, please. Yeah, so SIA Engineering, this is covered by Hashim. So he's away now. So I will cover on his behalf. So FY 2026 results is poised for growth amid geopolitical headwinds. Yeah, next slide, please. Yeah, so the full year performance was slightly below expectations at about 94.4%, the full year PATMI. But the growth year on year is driven by 22.5% surge in associates and JV income in FY 2026. Yeah, so looking at the positives is that there's strong growth in associate and JV earnings. So the engine and component segment was a primary driver, so it's up 23%. Airframe and airline maintenance also contributed 6.1 million. So that's on heavy check volumes and growth in flights handled at Changi Airport. So for the negatives for SIA Engineering is that there is gestation losses in the subsidiaries which will continue to persist. So it widened to about 16.1 million in FY 2026. So that is a huge jump from 2 million in FY 2025. So that is mainly because of base maintenance Malaysia's the heavy check facility commenced in November 2025. And the second hangar, which is not operational until second half 2027, as well as the TIA Engineering's Cambodia line maintenance operations, it commenced in September 2025, but there is some gestation period. So operations are expected to still below full capacity and expected to scale up from here. Yeah, so for the outlook for SIA Engineering is that the war, the conflict, in risk of higher material costs. So that is the material cost currently contributes about 23% of revenue. But right now, the APAC customer base provides some insulation from the direct demand. Yeah, and longer rerouted flight paths also could help to pull engine shop visits forward. So that's a potential tailwind as it scales to 400 engines per annum by FY 2028. Yeah, and the new facility in Loyang also will help to drive up cost pending completion in 2026. So MRO demand is still strong with slots fully booked. Yeah, so with that, Hashim, he upgrades to buy mainly because of the recent share price weakness and the methodology previously was 26 times PE, FY 2027. So now it's it reduced it to 25 times of FY 2027 PE. Yeah, mainly from the sector-wide risk from the US-Iran conflict. Yeah, so that's for SI Engineering. Yeah, I hand over the time now to Zain. Thanks.
Thanks, Darren. Good morning, everyone. I'll move on to the technicals. Next slide, please. So first one on the S&P 500, last week we saw a potential bearish reversal pattern, which is the evening star candlestick pattern at this key trendline resistance stretching back since July 2024. So I think potentially we could see some pullback and some sideways consolidation if the price falls below the 10 SMA level, which is the red line. So overall, for now, resistance likely to be at the 7,445 to 7,520 level area, and support is likely to be at 7,300 to about 7,375 area. Next slide. Next one, this is a chart of the Philadelphia Semicon Index. So for this, last week, it looks like there's a potential double top at the 12,100 level. And also with a slight pullback on Friday, the price actually retested the 10 SMA level as well, red line, coupled with a bearish divergence seen in the RSI indicator. So for this, I think we could see some likely pullback, continue pullback ahead and some sideways consolidation as well. If price falls below the 10 SMA levels, with some cooling off after this strong rally. Current resistance levels likely to be at 11,810 area to about 12,110, and next support levels are likely to be at 11,260 as well as 11,075 levels. And next slide. And last one from me, this is a table that summarizes the Philadelphia Semicon Index returns after we've seen a reading of the weekly RSI more than or equal to 82. So this is actually quite a rare occurrence, occur about 3 times in history, other than the one that we've seen recently. So the most recent one, if you take the highest reading, it was on 8 May, where it reached about 85.5. And then it was about 67% away from the 50-day SMA, which is a midterm trend indicator. So last week it dipped slightly to about 82.4, I think. And then the one returns last week was negative 1.5%. So looking back in history, the past 3 times we've seen such a strong RSI reading for the stocks was back in 1995, 2000, as well as 2017. And then in terms of the average returns afterwards, we tend to see some negative returns in the periods after. So 1 week returns on average about negative 4.9%. And then in the periods 1 month to 3 months, the losses tend to narrow a bit to about 1.5 to 2.9%. But in the 6-month mark, it could widen towards negative 4.5%. And then 1 year later, it tends to be quite negative, about on average negative 32%. So there's just some previous historical returns following such a reading. So that's all from me. I think I'll hand over time back to Darren, who will be covering for Paul. Thanks.
Yeah, thanks, Zane. Yeah, so Paul is at SIA Engineering briefing, so I'll have to speak on his behalf. So for ComfortDelGro, there was a weakness in taxi spreads. So their performance was next slide, please. Yeah, so their performance was below expectations. So their first quarter performance was below expectations. So it's about 20% of the 2026 forecast. So underlying PATMI in first quarter, it fell 16%. So the drag was a 45% collapse in operating earnings. So this was mainly from the disruption, also from the Edison Lee airport transfer. So that's like a limousine service. So for the positives is that for the first quarter, there was an improvement in margins of the London bus contracts. So the margins continues to improve, although it's not really impactful in the first quarter, but in the first quarter 2026 results, UK and the public transport margins were also down year on year. But for the negatives is that the taxi earnings decline intensifies. That's also from the falling fleet in Singapore and Australia. So basically the operating profit, it plunged 45%. So a fall in Edison Lee, like I mentioned, the airport transfers also was a drag in the UK. And also there was an overall contraction. Back to the ComfortDelGro. Yeah. And also there was an overall contraction in the consumer spending on taxi services as a weaker consumption. So lesser people taking taxis. So there was also a drag. Yeah, so basically for the outlook, there were 2 weak spots. So like I mentioned, the Singapore and Australia taxi fleet, the decline, and also the weakness in consumer spending on private hire, and also the disruption to the Middle East Airlines airport transfer, which is the Edison Lee airport transfer in the UK. Yeah, so with that, Paul, he lowers the earnings by 11%. So the target price is also lowered, and the recommendation is downgraded to neutral from accumulate. So now the target price is $1.35. So the higher fuel prices, additional surcharges, and weaker economic conditions also will soften the spending on the premium transportation services such as taxis. And the taxi operators also will continue to face additional pressures on intense competition and the declining fleet sizes. Yeah, next slide, please. Yeah, so for Netlink, the fixed cost is creeping up for them, but the cash still remains stable. Yeah, next slide, please. Yeah, so the FY 2026 results was in line with expectations. EBITDA was slightly below, but DP was 1.1% higher. The second half 2026 EBITDA declined by 5% year on year to 143.5 million. Yeah, so for the positives for them is that they had stable operating cash flows at about 258 million. So that's despite the decline in EBITDA, as there was a major decline in the cash taxes paid. Yeah, so the cash available for distribution is about 211 million in FY 2026, and that was supplemented by additional borrowings that was taken up. And yeah, so for the broad base for negatives, there was a broad base rise in fixed costs. So that was largely about 30% rise in staff costs, as well as operating and maintenance by 13% and other operating expenses. Yeah, so that was the negatives. And yeah, so for basically the outlook and recommendation, the target price is raised to 96 cents. So mutual recommendation is also unchanged or maintained. So the overall cash flow remains stable, and that covers the 211 million in dividends. And yeah, there is capex. Any capex is to fund future returns, but for now, Netlink's distribution yield of about 5.4% is not is like a so-called a equity, like a bond, but it's also equity, but the yield is also 5.4, so it's not extremely attractive. So, but at least this yield is supported by stable cash flows. Yeah, and we do expect FY 2027 to be affected by rising fixed operating costs and finance expenses. Yeah, but generally when they do capex, there is a potential for future growth, but in the near term, might be impacted a little bit. So other areas of this growth will include the use of these common central ducts in the new HB locations and higher central office revenue from more rack space as the transition to 10 GB bandwidth plan continues. Yeah, next slide, please. Yeah, so for ThaiBev, they had record gross margins. So their results were within expectations for the first half. Next slide, please. Yeah, so the results were within expectations for the first half, and for the first half, usually it's seasonally stronger for ThaiBev. So their gross margins expanded, but that's mainly from the decline in material costs, malt and molasses. Yeah, so for the positives is that the gross margin was at record levels. So the first half gross margin is at 32%. So that was due to a rise in beer margins. So that's largely from the decline in material costs from the 30% drop in malt prices. Yeah, there was also a price increase in tobacco. Yeah, and for the negatives that there was a fall in non-alcoholic beverage earnings. So that was mainly from a decline in volumes, startup losses at FNN and Agri Valley, and FX loss and lower cross-border trade due to the geopolitical developments. Yeah, so for the outlook, spirit volumes is gradually recovering post a fourth quarter collapse due to floods and border conflict. Margins are likely to hold due to forward purchase of molasses and bottle recycling. Yeah, so the margin is expected to hold until at least this year. Overall demand should for them should continue to basically should enjoy a boost from the World Cup, which is upcoming in June. And we also expect the marketing spend to tighten as the return on these advertisements will be low due to the fragile consumer sentiment. Yeah, so with that, we upgrade our recommendation to a buy due to a recent share price performance. Earnings and target price are unchanged. So valuations are based on 12 times FY 2026 PE. Yeah. Next slide, please. Yeah, so for Singapore Weekly, yeah, so the SI numbers are still strong. So you see the capacity is up 4.3%, so there's no disruption to capacity. And the demand is also basically up as well. So they picked up share from some of the Middle East airlines. Yeah, so that's for SIA. And for new home sales, it's strong, continues to be strong. So in April, it's up 129% year on year. It's mainly because in there are two launches, so that was really well taken up in April. So the Tengah Garden is at 99% taken up, and the Villa Bay is 72%. In May also there was a launch in Hudson Place, so that's also very well taken up, 60% at launch weekend. That was just this past week. So demand remains strong even despite the Middle East conflict. So basically the issue for new home sales is the limited supply. So demand is no issue from what we're seeing. For exports, South Korea exports, it jumped like 50%. Taiwan exports also spiked. But that's mainly because what we see is a lot of forward buying. Everyone is basically shoring up inventory in everything. Yeah, so the exports are spiked. And for inflation, it rose. No surprise there. CPI numbers, energy services and such. Next slide, please. So for tactical views, here are some of broad takeaways from the key results. So this first of all from Genting Singapore. So from Genting, the profits it fell 55%. This mainly from the market share loss in VIPs from an estimated 30% just a quarter ago in fourth quarter 2025 to 20% in first quarter 2026. If you take a look a few years back, the market share is probably around 40%. So going forward, we expect the performance still to remain kind of weak, but we do expect performance to improve after 2026 near the completion of a lot of the construction at RWS. So RWS 2.0. We have a Phillip on the ground slide on that later. So talk more about it. For SIA, this is covered by Hashim, but he's away, so I'll cover for him for now. But basically they are very much better than other airlines. They're adding capacity while they're taking market share from the Middle East airlines. So other airlines are basically cutting capacity, but SIA they are adding. Air India losses currently there's no visibility. So for that their track record also for investments also not that great for SIA. So that will possibly be the threat. For SingPost, the PATMI of 10 million. So the letter and postal network continues to see losses. For SingPost Center, previously they mentioned that they wanted to divest it. So the valuation is about 1.1 billion previously. So now they've mentioned that they'll keep SingPost Center and they'll undergo restructuring and turn around losses in other divisions. For AEM, they raised their revenue guidance by 20% to 44% year on year. So that was just a quarter ago, and then now they already raised by 20%. So the demand is strong. But that's mainly due to the demand from its new GPU customer, which we think probably is AMD. So currently the CPU customer is not fully loading from Foundry and 1-to-1 CPU in agentic. So basically what this means is the agentic CPU ratio is 1 CPU to 1, but previously it's like from 1 CPU to 8 GPU or 4 GPU, but now it's 1-to-1. So Intel is their previous biggest customer. It's expected to get more business from becoming the upcoming Foundry. And they're gonna need more CPU. So that is a potential growth driver for AEM. For this, we have more updates when Ekban comes back. So he'll give an update on this. And for First Resources, the palm oil backdrop is still positive. So the B50 Indonesia 3.6 million metric tons is 4% of global demand. So that remains strong. And because of the high diesel price, some equipment tractors are using B100 or full biodiesel. And also there is a risk of the El Nino. And also because high fertilizer price, so some farms are under fertilizing. So that is another risk to production. So for the week ahead, we have SIA Engineering, which is out already. Nvidia tomorrow and Walmart, Singtel, And we also do have some corporate insights webinars like Centurion, Oxbay, AIMS APAC, a couple this week and a few next week. Next slide, please. So economic environment is healthy. So we look at this chart, SI passenger kilometer that is increasing. So it spiked up for SIA. So that is both capacity and demand strong. And for the exports, we see AI is stocking up demand, like we mentioned just now. There is a lot of forward buying. Everyone is storing up inventory. So you see the numbers for export numbers really to spiked. Next slide, please. So more in detail for Genting Singapore's first quarter business update. Yeah, so if you don't know, they're integrated resort and casino. So PATMI was down 55%. Gaming revenue was down quite a lot, 8% as well. Yeah, so basically they lost like I mentioned in the earlier slide, there was a significant decline in market share to MBS. So now it's about 20% from previously 40%, and last quarter was 30%. So they also mentioned that they are giving lesser credit um to players, and that is also kind of affecting them. Their credit extension is focused more on the player quality and credit. Yeah, so for them, they are looking to defend their 4 cents dividends, and for capex wise, it's expected to peak next year for 1 billion per year, and 2026 the upgrade Hotel Michael and Oxford. Yeah, so for the outlook, it's still a work in progress stock until 2030, basically after the RWS 2.0 is completed. Assets are still being refreshed, so Laurus launched in October and phase opening. So the full recovery we think will be after the RWS 2.0 is completed. So that is still some time. But in the meantime, they're still continuing to lose market share from their VIP segment. Yeah, next slide, please. Yeah, so for SingPost, their full year results, they operate postal networks and malls if you do not know. So the PATMI, their underlying PATMI of 5%. So they suffered losses in post network and logistic and letters in the second half of 2026. Yeah, so going forward, they are looking to turn around this 10 million operating losses. So this is focusing on raising rents, mainly in Simple Center. So for logistics, they are increasing the parcel capacity, the lower cost to serve, and 10 cents increase in postage. Yeah, so for the property, like I mentioned, also they will not sell Simple Center as initially they came out to say that they are intending to sell that. So there is upside in keeping this Simple Center in AEI and relocating the sorting center. So plus they also can lease out some of the warehouse space. Yeah, so for Simple Center, their valuations is really backed by this valuation of the Simple Center of over 1 billion. And there is upside from restructuring and the IMDA review and asset sales. And yeah, so we do expect some turnaround, but it requires some time for them to significantly turn around. Yeah, next slide, please. Yeah, I think that's all. Yeah, so we can move on to questions. Thanks.
Okay, I'll start by taking some questions. How do you expect Anthropic's relationship with cloud providers, AWS, Azure, Google Cloud to evolve? I think right now it is pretty obvious that Anthropic, they're trying to deliberately diversify their compute supply across all the different hyperscalers because the AI demand just too huge, and it's simply just too big for them to rely on just one single provider. My personal view, maybe the other analysts didn't agree with me, but they can add on after my answer. Maybe I think right now AWS still looks like Anthropic's closest strategic partner today, because they invest heavily into that, and cloud is deeply integrated into Bedrock, and Anthropic has already committed massive spending towards their AWS Trainium infrastructure. On the Google Cloud side, maybe it's more like a second pillar, especially around their TPU. I would say Azure probably has the weakest relationship strategically because Microsoft still remain heavily aligned with OpenAI. I personally think in the future it will be revolving into somewhere like AWS is going to be the primary distribution partner, and Google Cloud will be probably the TPU infrastructure partner, and Azure is probably like more of a secondary partner. But yeah, I'll leave the question here for the other analysts to add on. And there's another question about AR market. How do you think the AR market will evolve in the next 2 to 3 years, and where does Anthropic and OpenAI fitting? I think a few years later, the market will shift purely from, because right now it's still more of the best model wins, but maybe a few years later, it's going to shift into a more broader ecosystem battle. Right now, OpenAI is the strongest in customer adoption and overall platform ambition. Because they're spending across the ChatGPT and enterprise and search and productivity. And Anthropic is more focused on enterprise and coding. And they have very strong positioning because they're trying to do a lot of partnership with AWS and Google Cloud. In the longer term, I think the biggest moat will likely become distribution and enterprise integration and maybe compute access rather than which raw model performs the best. So this also leave the question here in case other analysts want to add on. So there are also some company-specific question. How's Shopee's faring like versus the competitors like TikTok Shop, Lazada, Temu? I would say Shopee right now continues to fare fairly well against its competitors. I would still say it's the leading e-commerce uh, platform leader. But we are seeing intensifying competition because the Shopee, how it benefit is it has very strong logistic capability. It has a larger merchant base and deep fintech integration. TikTok Shop recently, they're trying to gain shares rapidly through live streaming, their advantage, and particularly in lower ticket categories. Lazada is, I would say, it's weaker in user engagement and market share overall. And Temu is doing a very early age when it comes to Southeast Asia. It's mainly competing through aggressive pricing. We think Shopee's strength is likely to continue, especially now that we're seeing them ramping up the investment. How much will memory costs impact Apple in the next quarter, and how will the company offset this? So Apple did comment that memory cost is already affecting their margin, and the impact will rise more meaningfully in the next quarters and pressure their margin more, but they didn't really quantify the exact impact. But I think from their point of view, if that's the case, they're probably going to offset it through favorable product mix, especially through the higher end iPhones and supply chain optimization and overall operating leverage because they're seeing very strong continued demand for their product. OpenAI is reportedly considering legal action against Apple. What's your take on this? I think it's more like it's not a pure legal issue. It's more like a strategic power struggle, right? Because Apple historically, they always try to have the habit of controlling their user experience itself rather than let partners becoming too dominant inside its own ecosystem. So I think when OpenAI entered the partnership, they were kind of hoping it would be more deeply embedded across its iOS, sort of like how Google search was almost a monopoly when it comes to Safari. So that's what they had in mind. But I think Apple is trying to treat it the AI model more like interchangeable backend providers. But in the near term, I don't think it's going to negatively impact Apple much because they can always work with Gemini and Cloud and etc. So not so much. Another about Amazon. Amazon rollouts 30-minute delivery. How much can it benefit the profit? In the near term, I think it will likely even pressure the margins a little bit because ultra fast delivery is very expensive and requires a very dense logistic network and very high last mile cost. But however, in the long term, it would definitely be meaningful to strengthen their competitive moat because it increased the purchase frequency. Because if I'm able to delivering ultra fast, then a lot of things, if I cut my hand, then I can probably consider buying like a bandit from Amazon. But usually if I need it urgently, I will try to get it from the pharmacy offline. So this is definitely gonna try to improve their stickiness and capture more spending and take shares from competitors who previously are probably not even their direct competitors. Because previously they're just the e-commerce, now they're trying to gain more from the grocery and the convenience sector. So yeah, I think in the long term it will be meaningful for them. Yeah, I guess I'll pass it to my colleagues first to take some of the questions. Thank you.
Thank you, Alina. So, taking this one question on Microsoft, what's your view on Bill Ackman's comments for Microsoft? So Bill Ackman is for your information, is the billionaire for a hedge fund in the US. So what he said is that the recent pullback created an opportunity to buy one of the world dominant technology, which is Microsoft, at a compelling valuation. which at that time, I think about last week, valued at 21 times of forward earning, which is in line with the market multiple and below the market trading average over the last few years. Shares, because Microsoft shares have fallen more than 26%. We agreed with him that we think that sell-off was largely driven by the market fear, like like AI with its software, and then specifically Microsoft capital expenditure investment won't produce the result. I also think that the market is overreacting. From the recent result, you could see that Cloud Azure managed to sustain its 40% year-over-year growth, and they were able to also deliver 1.2 times of their AI-related business growth in annualized recurring revenue. And also not to mention that software users are still growing. Now it's at 450 million users, still at one of the largest software users providers, and I do think that the penetration rate is high as well. So I agree with him that the share price plunge provided an opportunity. That's what he said. Next question is on Palante. Does Palante have the risk of over-reliance on the US market revenue? What are growth drivers for international market? So a big portion of the Palante revenue is from the US region, but we don't think that this would pose risk to Palante anytime soon, because you see US region has been the majority revenue driver since the company establishment about 12, 15 years ago. And they are doing just well, right? They always prioritize the US region. And from the recent result, the acceleration of growth is coming from the US region, and especially the commercial. We don't think it's slowing anytime soon. And the backlog is also growing quicker, more specifically to the US region. Pricing power is growing by 50%, and they also have customers on the recent quarter. And for the international region, it's not growing as fast as the US region. We believe it has to do with the foreign countries are being cautious to allow Palante, which is a US-based company, to have access to their data. So this is kind of like a sensitive spot. So regardless, still, the Palante CEO has reaffirmed many times that he would always support the US region over the other countries. So I do think that moving forward, you would still see that US region make the big chunk of the Palante revenue. But I don't think that's a bad thing, of course, especially for companies that are growing, hyper-growing for like Palante that come from the US region. And we don't think that the slower international growth compared to the US region will slow the Palante's growth. I don't think so. So there's two questions that I'm taking. I will pass over to my colleague to answer some of the other questions.
Yeah, apologies for that. A lot of us are away. Let me take on some questions. Sorry, let me see. And how was NTT-DC REIT's results? Yeah, so their results were very strong. So they beat their IPO forecast significantly. So the occupancy improved. So committed occupancy now is at 98.5%. And also the rent reversion also was very strong, of 8%. So that was driven by the SG1 renewal. So that was renewed at 23% rental uplift. So their performance was strong, and their portfolio valuation also increased 11%. So that was the increase was also very broad based. So it's led by VA2 25% and SG1 20%. Yeah, so for their performance that was really strong performance for our first quarter. So it basically also beat the consensus and this consensus also, but we don't cover, so we don't really have a target price for that. Yeah, but generally their results were very strong. Yeah, so I think that's also slightly reflected in the share price. Yes. Yeah, apologies for that. A lot of the questions we can't answer because it's for either Glenn, the banking side, Iqbal, or Paul. So there are three of them are not around. Uh, yeah, but if you have any burning questions that are answered, you can put it in the Telegram or P3 chat. Sorry, not Telegram, the P3. So let me see. Yeah. Then will you put your money in Mapletree Industrial if you can choose within Mapletree group of listed companies? Yeah. So Mapletree Industrial currently they're actually undergoing a lot of I will call it so-called restructuring because they are looking to divest some of their US non-performing data centers, while the vacancy they're still facing some vacancy issues in the Mapletree Industrial. So for me. For Mapletree Industrial, while they're undergoing this restructuring, I won't I'll stay away for now. Yeah, until possibly we see some green shoots or any firm portfolio restructuring or any significant improvement in portfolio operating matrix, then yeah, we could possibly look at Mapletree Industrial again. But for now, we think they're still undergoing kind of a portfolio change or yeah that restructuring. So we think from our view we stay away. Yeah. Views on Escort. Yeah. So for Class, their portfolio is really resilient because a lot of their portfolio is backed by stable income sources. So which has either master lease structure or management contracts with minimum guaranteed income. So we still do see a rental growth of about a RevPAR growth of about low single digit, possibly 1 to 3% RevPAR growth for the full year, despite the geopolitical tensions. And they do have a little bit of US exposure, so that will benefit from the World Cup. And yeah. So that's generally our view for Escort, stable. And they've also guided that they will keep the DPU stable at 6.1 cents. So that they will use some of the previous divestment gains to offset some of uh, the divestment or rather the AEI impact of the Cavendish London. So basically, DPU we are looking at 6.1 cents. So if you look at current share price, I believe is over 6% yield. So we think that is attractive for Escort. Yeah, but the portfolio is really resilient because of the stable income sources, like I mentioned, the master lease structures and the management contracts on minimum guaranteed income. Yeah, UI Bauxite REIT keeps retreating in price post IPO. What are the qualities that my market is like about this new REIT? Yeah, so this I don't really have a good answer for you, but I'll guess for UI Bauxite REIT, it was quite unfortunate that the timing of their IPO was really during or around the start of the war, so that really impacted the investor sentiment. Yeah, I think that was one of the key factors why also on IPO date, yeah, the demand wasn't really that strong. So share price has not really recovered to IPO price since then. Yeah, but what market is I can't really answer that. Yeah, so I don't really have a good answer for that. Yeah, it's a question. Darren, what's the main reason in upgrading SIA Engineering? Yeah, so actually SIA Engineering is covered by my colleague Hashim. But I was just speaking on his behalf because he's away. He's actually away on a site visit. So I don't really have a good answer for that. Like, has their Malaysian operations started functioning and contributed? Oh, yeah. So there is some gestation period, like I mentioned during the presentation for SI Engineering, but the SI Engineering basically the share price it was upgraded to buy from previously it was accumulate. That's mainly because of the share price performance. The target price actually was downgraded. Actually, yeah. So previously it was 26 times FY 2027 PE, but now it's 25 times. Yeah. So previously the target price was $4.14. So now it's downgraded to $4.04. Sorry, $4.06. Yeah, but the so-called the recommendation upgrade was mainly because of the share price weakness. Yeah, so that was why the so-called an upgrade in the recommendation. Yeah, but basically you're asking about the Malaysia side. So there are base maintenance Malaysia, there are Subang heavy check facility. It commenced operations in November 2025. But the second hangar is not operational yet until the second half of 2027. Yeah, so there is a gestation period there. Yeah, so that's a very the next question is Prime US REITs first quarter distributable income dropped from 8.4 million to 6.5 million. So is there any rate on this? Yeah, so this is actually a very good question. So that was also one of my key questions to management. But basically that's because the income dropped so much is mainly because of the fact that I mean, as you know, the leases expire, and even though we see over the past year, the occupancy has continued to improve. But as leases expire, so maybe previously 80% or rather 83% occupancy, then as leases expire, the occupancy continues to drop to like 70%. But as they release up the occupancy, the committed occupancy will go back up. So there is that gap because the new leases they signed are not contributing cash contributions yet. So because of the rent-free period, so they do not so get the cash income. But at the same time, there is a fall off of a cash contributing occupancy from the expired leases. Yeah, I hope that kind of explains it. So that is a big reason why also the distributable income it dropped quite significantly, like you mentioned, from 8.4 million to 6.5 million. So currently only about 73% of their portfolio, even though their occupancy is at 83%, only about 73% of this occupancy is contributing cash rentals. So basically contributing cash flows. So going forward, progressively from the third quarter of 2026, this so 11 million that is still under rent-free period that were leases, large leases signed or over the course few quarters or even until 2025. So that will start contributing cash. So we expect the DI to really increase from here. The increase contribute basically DI to increase from here. So it's not really a red flag because this was kind of expected decline as well in the portfolio, the DI. Yeah, but going forward, as all these leases contribute and the DI continues to improve, then we expect over time also that distributable the distribution payout ratio to increase from the current 65% to basically higher, especially since there is a lot of visibility from the cash flows that are coming in from the leases already signed. So general rule, if you do not already know, is that when they sign leases of about 10 years, they are looking at about 10 months to about 1 year rent-free period. So for instance, if I sign if they sign a lease like now, then if they sign like a long lease, like maybe over 10 years lease now, the cash contribution will only start coming in next year, May. So it's roughly around there. So that is why the distributable income dropped so much. Yeah. Yeah, how bad occupancy for Maple Tree Industrial? Yeah, so Maple Tree Industrial, the occupancy, there is some known vacates. So if I'm not right, off the top of my head, I remember the North American DC occupancy around 80 plus, but that on top of that, there are some known vacates of about 4% as well. So the occupancy there is expected to decline even further. Yeah, so you are right that the occupancy is continues to getting weak is getting weaker. There was news of Capital Investment REIT acquiring or JV of the Maple Street REITs. Also, I'm not quite sure what you mean by this. But what I think you're asking is there is news of the so-called merger between the parent CLI, Capital Land Investment, and the Maple Tree, or so-called merger or acquisition, acquiring Maple Tree. So it's not so much the Capital Investment REIT, because the parent is the sponsor, so it's not really REIT, but they manage quite a number of REITs under them, like Class, Capital Land, CICT, and such. Yeah, so basically you're right that there is rumors of news, but they say in their words is nothing is firmed up, and they are always sourcing or looking for acquisitions to kind of increase their AUM to their so-called target 200 billion. So if you do the maths, currently the CLIs, their funds under management, if I remember correctly off the top of my head, is about 125 billion, and Maple Tree's AUM as a whole probably around upwards of 80 billion. So if they do that, then they'll immediately hit their goal. But yeah, that is basically still rumors. No firm news for that. Yeah, but when every time someone asks Capital Land Investments Management about this, they will say that they have done their so-called their due diligence and their numbers. So they are actively sourcing opportunities. So yeah, so basically that's their reply. Hi, KIT management said they aim to provide stable DPU, not growth. What do you think of REIT with no DPU growth? Um, for me, I think usually we do expect DPU growth, but in so-called macroeconomic environments where the operations are weak, like possibly interest rate increases where or that will affect DI. So most REITs will expect DPU to drop. But if you are one of the REITs that so-called can expect stable DPU instead of declining DPU, I think that will also be a positive. Yeah, so I guess really have to see the market conditions. So of course, it's good to see DPU growth year on year every year. But sometimes when markets are challenging, it's hard to, especially in rising interest rate environment where we saw like a couple of years back, the interest rate shot up. So as a result, basically most REITs, if not all REITs, saw DPU declines, or rather 99% of REITs saw DPU declines. So in that situation, if you can provide stable DPU growth, I think that would be a positive. Yeah. Okay, going forward, what's your view on REITs as market might be of the view no further interest rate cuts down the road might even spike up? Will there be a negative impact on REITs? Which ones will be worse impacted and those with resilience? Yeah, so basically, as we all know, if the interest rates remain higher for longer, or even if interest rates increase, definitely that will be negative for REITs, as they will experience like possibly cap rate expansion. So cap rate expansion also, that means lower property valuation, so that will impact them, as well as the more obvious just upfront increases in finance costs. So that will also eat into the distributable income. So, like as you pointed out, definitely this will be a negative impact for REITs. But most of the REITs, how they try to manage this interest rate impact is by hedging. So currently we see most REITs hedged about 70 to 80% of their interest rate exposure to fixed rates. Yeah, so hopefully at least that can mitigate some of the impact of so-called potential higher interest rates or higher for longer interest rates. Yeah, but generally what we see is in Singapore, even though the SORA rates so-called over the past few days, if I'm not wrong, it did increase. I know it increased slightly last week after it declined so significantly, but it still remains very low, like 1.1% for the 3 months SORA, if I remember off the top of my head. So that is a lot of the Singapore REITs with SGD denominated loans will continue to benefit from the very low interest rates. And especially if they do refinance their SGD loans, so they'll continue to benefit from cheaper refinancing spreads. Yeah, so for Singapore side, we don't really see an issue from the interest rate point of view because it's so low, the SORA. Yeah, but if overseas REITs, we might see a bigger impact on those, especially in countries or where the interest rate basically the central bank increases the interest rates. Yeah, if interest rates rise, this will have a very negative impact on prime US REIT. Yeah, so if interest rates rise, definitely the impact on prime US REIT we do think it will not be insignificant, I would say. Because first of all, 50% of their hedges expires in June 2026. So those were on lower rates. So when those reset, they will be at a higher rates. So basically those interest rates hedges were at lower rates. So when those expires, the all-in cost of that the all-in interest cost will increase. So we do expect to remain below 6%, assuming current rates. But if the base rates or the Fed does high interest rates, then that will definitely have quite a significant impact on prime US REIT, because at that point in time in June, they are basically, if I'm not wrong, if I remember off the top of my head, like less than 20% of their debt will be on fixed after the expiry of the June 2025 tranche. Because the June 2025 tranche is quite significant, at 50%. Yeah, so management did guide that when they do refinance, they will look at hedging again. So yeah, hopefully that will mitigate the impact. But assuming, yeah, like interest rates, assuming the Fed hikes and they have like 80% of their loan book on floating, then yes, definitely they will be impacted quite significantly. Yeah, but generally we think a lot of the negatives for prime has already been priced in, because prime is already trading at 0.34 times price to NAV. So there is really a huge discount. And even at 65% payout ratio, we are looking at a forward yield of over 7%. So just looking at these valuations, we do think a lot of the negatives has already been priced in. Yeah, another question. Hi there. With power stepping down, do you think interest rate will trend upwards or trend downwards going forward? Yeah, so that is really hard to say. I can't really give a good answer or forecast to that. So personally, I think interest rates will likely stay flat this year. I mean, that's just my personal view. So no rate cuts or no rate hikes this year. I mean, that's just my view. Yeah, I think I answered many questions. Hand over to my colleagues to answer some first. Yeah, then I'll come back in if there are any more. Yeah, thanks.
Let me take some. Oh, sorry. Can go. Some question, I guess. Yeah. Some question asking some update on Oracle, TSMC, and yeah. But Ivan is away, so we can't really take on your question on this semiconductor company. But for Oracle, some update on it that they solved their capital expenditure problem recently, which that they now, since they secured externally about $45 billion from raising equity and as well as bond. and which should be sufficient to provide capital expenditure expenses targeted for the year, which is $50 billion US. And also not to mention their fundraising mechanism, which now the client would have to bring their own GPU or pay upfront, which should ease the cash flow burden for the year instead of just negative as they previously provided, which provide a negative picture for the company. And also for the outlook, OpenAI going public at the end of the second half of the year, we think would benefit Oracle in the long run, because when they are able to raise their fund in the IPO market, they would be able to pay the commitments that they made, especially in the first year, which is 2027, which would also include Oracle, part of the commitment, which would be good for Oracle. The near-term outlook would be looking at the SpaceX IPO, which is a bit of unrelated, but then again, if SpaceX is able to raise sufficient amount of fund as they targeted for the year, which would imply positive outlook for Oracle as well, hence the share price moving upward, hopefully. Yeah. And also, next question is on the comparing Airbnb and Trip.com. For Airbnb, they provide vacation rentals and homestay, which should be different than Trip.com. They who provide more holistic services, which is mainly hotel and train and full travel booking. For revenue-wise, both are growing modestly. Both are growing at 18% and 16%. And for Airbnb, for the growth is driven by the booking volume and pricing. Both are growing at 9% respectively. And growth is coming from the Europe, Middle East, and Africa, and also APAC region, and also from the multiple product improvements that they made along the way. For Trip.com, it's a bit different. Growth is coming from the strong hotel and air ticket demand, particularly from the Asia Pacific and outbound Chinese travel normalization. But then again, since we have this cancellation coming out from the both EMEA region, travel demand we expect travel demand to remain volatile due to the high cancellation sensitivity in the recent near term, and also flight and hotel disruption would affect both companies. I will pass over to my colleague Zain to continue with his technical analysis question. Thank you.
Thanks, Kwame. I'll move on to pick the TA questions. So let me just try to share my screen. Okay, so first one on Everglory, TeleChoice, and iOS Biopharma. So for TeleChoice, I think most likely price action is quite range bound right now. So I think so mainly the support is at 23 cents and the resistance at 26.5 cents. Then there was a bit of a slight gap up, I think, on Thursday. Then found some support at 24 cents, which where the cluster of moving averages are, and then doing a bit of a bounce today. But generally, yeah, a bit of low volume as well. So I think most likely it will be quite range bound. Yeah, in terms of the moving averages, well, also still trending above the weekly 5 and 10 SMA level. So I think that's still pretty much okay. Maybe something similar to what we've seen in June to July period last year. And for Everglory, for Everglory, I think in terms of the price action, I think some possible weakness ahead. After the recent rebound, I think the price was unable to hit this, to retest this high around 88.5 cents level. And then afterwards we tend to see some weakness from Thursday onwards, where price is below the 10 SMA level as well as possibly this short-term trendline support. So I think near-term support that could retest is the 79 cents to the 80 cents 20 MA area. So this seems to hold. If not, we might continue to see some weakness downwards. The next key support after that could be somewhere around 75 to 76 cents area. Then resistance for now is around 82 cents to 84 cents for Everglory. Yeah, then next for IX Biopharma also looks like some consolidation for now, at least. Yeah, some weakness since the high on 15 April with some lower highs along the way. And then currently another thing is that price is also there was a breakdown, I think Thursday below this 39.5 cents to 40 cents sideways range, as well as the couple of short-term movement, which is 5 to 20 SME levels. So I think short-term wise, price might retest this support level, 35.5 cents to 36 cents. You might do some slight bounce, but I think it will be a bit of a lower high with some resistance coming in at 38 cents to 39 cents area. This where the moving averages are right now. Yeah. So I think this needs to hold this 35 to 36 area to hold this descending triangle formation. If not, we might see some downwards if it breaks below this support. Below that, the next support I think would be around 33 cents about there for IX. Then in terms of weekly chart, also currently below the 5 MA weekly as well. So some weakness coming. Okay, next one, some US counters. First one on Nvidia. Yeah, for Nvidia, I think generally still quite strong, but I think we might see some pullback in the short term after this strong rally last week. I think price was above the upper Bollinger Band, and then in terms of the Friday candlestick, it opened at the Thursday opening price, and then it closed near the lows, retesting the 5 SMA level at 225. So I think short term wise, we are likely to see some pullback. I think possibly to retest this 206.17 previous high, as well as wait for the 10 SMA to catch up. We might do a retest. So about 217 to 220 might be the support for some pullback. In terms of Meta, I think nothing too much for now. It's still very range bound since the earnings gap down over here. Price still holding support at 600, and then the resistance still 620 to 630 about there. So I think will be still quite range bound. Looks like still pretty much range bound for now, unless you can do a close above 630. Then above that, the next key level will be about 640 and then 655 about there. Also needs to get above the 20 SMA level as well. Yeah. And for now, at 600 below 600, next key is about 580. So I think just look for whether price can break out of either side. In terms of Microsoft, I think price action, I think still okay. It looks like still in this range consolidation. I think more towards upside than downside. In terms of the key resistance, I think still the 100 SMA level, this blue line, price has tested this multiple times. So if you can, I think if price can, if this week can try to close above this 100 SMA as well as this short-term trendline resistance and swing high at 427, then we might see some possible continuation of rebound. So it looks like this is a rebound wave and then some consolidation taking place right now. So yeah, so we'll see whether price can try to break upwards. In terms of their support is still holding okay for around 400s. Yeah, then next one on IGV, which is a software sector ETF, I think it's still holding up pretty well. So looks like the break of this inverse head and shoulders formation, neckline recent $88.50 is still holding well. With last week price did a retest and then still holding support horizontal level as well as 10 MA, and then closed quite okay on Friday as well. So I think we could still see some further rebound up to retest on the next previous breakdown levels we've seen earlier this year, like 94.20 was a breakdown, and then there's a gap fill over here at 97 about that, and then next one is 99. So these are some of the next levels I think price could still try to rebound up. And then I think also is above this now I think looks like it's quite firm above the 100 SMA level as well already. So still positive signs for IGV. Next one on TJX. Yeah, for TJX, I think price in the short term still looking weakness. So last week we looked at breakdown of this 152 support level, and then this was also like a bit of a 152 was also this channel support. So afterwards, I think most likely back to this support area next at 145, 146 about there. Price will do some sideways over here. Yeah. Then I think short-term resistance will come from the 148 to 150 over here. And I think also earnings coming this week. Next one on Visa. Yeah, Visa, I think price looks pretty sideways for now. So price last week managed still holding this 318, 319 previous resistance over here as support as well as 20 MA area. So just consolidating sideways, some resistance now at 329. So if price can go above this level, next resistance will be likely at 333, and then this next one, the swing high over here at 341 over there. So I think for now looks like price most likely will still do some sideways movement over here. Okay, the next one is on micro mechanics. Yeah, for micro mechanics, I think short term wise we could see some pullback consolidation after this rally. Price, I think there was a bearish candlestick pattern over here on Friday on high volume as well, and then price is below the 5 SMA for now. So I think we could see some pullback to retest some levels like 330 to 335 where the 10 and 20 SMEs levels are, and then then price might do some sideways movement about there. Next on CSE Global also, price came down on high volume on Friday as well, breaking the 5 MA. Today is looks like some resistance at the 5 MA 165 and then retesting this 158 MA level. So I think price might do a bit of a sideways over here, but I think you could still see some further pullback. I think if it breaks below the 156 level, which is currently the swing lows for the past 2 days. Below that, then the next key support 148, close to 20 MA level as well as this horizontal support level. So I think some short term, most likely some pullback weakness after this rally on high volume on Friday. And then next for AEM, also I think most likely price will likely do some pullback as well. After this very strong rally, last Friday we saw this bearish candlestick on Friday. Looks like some profit taking in the short term. Today testing the 920 level with some resistance intraday as of now as well. So if price breaks below the 5 MA as well as the day lows like 878, then we might see some further pullback to close out this gap at around 835. Then that will be the next temporary support. Then maybe price will do some sideways as well. I think on the weekly, I think it's pretty overbought as well. The weekly is last week was about 93 RSI, then now it's about down a bit to about 87. The next question on capital. Okay, capital, I think today as of now it's down slightly about 3%. Then we tested a 200 MA level. So I think continue on the weakness from last week. With the breakdown is the 1070. So back to retest this about 1015 previous consolidation resistance level. So we might see some support holding here for bounce. I think short term wise will likely still be resistance about 1040, 1050. Below that, the next support about 985 and then 960s. Previous support level from November to December period last year. But I think on the daily RSI, I think about 27 right now, it's quite low already. So I think if you look back in the past, other times it's been so low was back in, this was Liberation Day last year, April, and then the August 2024. So in those both periods, I think we tend to see a bit of rebound afterwards. So a bit similar to what happened to Singtel. I think a bit similar to what happened to Singtel share price recently. after some pullback. Once the price kind of stabilizes sideways with the RSI oversold, then we might see a bit of rebound afterwards. Next one on SGX. So I think for SGX share price, looks like a consolidation phase taking place right now. After the rally, price has started to move sideways since April. Resistance is about 21.50 onwards, and then key support is about $20.40, $20.50 about that. So I think short-term wise, we'll just see some sideways movement, and near-term resistance, I think 21.20 about there. And then next question on CDL. So for CDL, I think price, I think still kind of sideways, but a bit of weakness, I think, from the breakdown of this $8 to about $8.10 area last week, with high volume on Thursday as well. So back to retest this 780 swing low support. Yeah, price holding a bit sideways over here, but near term wise, I think will still be quite weak. Resistance about 795 to about 806 about there. Then the next support levels, I think, for CDL could be at 766. And then next one is about 745 about that. So I think short term wise a bit sideways, but I think will still be some weakness in the near term. And next on UOL, I think for UOL, perhaps the key important reasons, trendline support to watch could be from this trendline support since September last year. Short-term wise, we see some price weakness where price did a consolidation recently, and then there was a breakdown of these 1020, 1030s range support level back to the next support level at 990. So yeah, short-term wise, price might do some sideways with support at 980 to 990 area, but most likely we'll still see some weakness, resistance from about $10 to about 20 about there. And for capital investment, yeah, price is after some sideways over here, 263 price give broke down, and then also still facing resistance from the 5 and 10 SMA level. So I think we could see a retest of the support again, 255, 266 over here, then do a bit of rebound with resistance at 260. Below that, the next key support will be around about the next area at 247 to about 251. Next, for Capital Ascenders REIT, also with a breakdown of the support at 247, 248, we could see a retest of these 239, 240 area again. Yeah, this swing low level, and then also back to this long-term channel support as well, around 240. And so this was formed since like October 2022. And next on UMS, I think in terms of the share price currently, I think after a strong rally last week, I think we're likely to see some pullback. Yeah. High volume as well last week, and then bearish candlestick on Friday. Today also looks like some rejection of above the 5 MA level, as well as the closing prices like 285 to 288 over here. So most likely, I think we'll continue to see some pullback. Next support level, I think, could be this closing price 260, and then wait for the 10 SMA around here. Then we might see some bounce. Yeah, so 260, then below that, next one is like 240 around here, this area. The next one on UOB. Yeah, for UOB, I think most likely a bit range bound. Looking a bit better with price trying to break above this $36.70 to about $36.80 this resistance area. So retesting this 37.40 level, we might see some kind of sideways movement over here. Some short-term support about $36.95, $37 over there. So if price can hold these higher lows, then I think there could still be a possibility of price trying to inch a bit higher towards like $37.80 to $38 area. For now, I think overall it's still pretty sideways, but in terms of the price action, looking a bit stronger recently. Okay, the next one on the STI. So for STI, I think general trend I feel is that is currently consolidating in this ascending triangle. So higher, this is a key trend line support, and then the key resistance is at the 5,000 area about there. So still consolidating sideways, higher lows along the way. Yeah, so for now, I think nothing too much. Might find support from this previous area of resistance, like 4,930 to 4,960 area, slightly could hold as a bit of support. And then resistance could still hold at this, the 5,000 area. So still pretty much sideways. Yeah, so I think maybe towards end of May or June period, then we might see a direction for STI. Yeah, next for oil tech, I think price last week did like a double top in the near term, at this 253 level. And then yeah, also some bearish divergence on the indicators as well. So short term wise, I think we could see some pullback. If price cannot hold this 243 level as well, which is a 5 MA, then we might see some further pullback towards like 236 as the next level, and then 230 as well. So some could retest some of these support levels things. Next one on sets, I think price action still pretty weak. Last week after retesting, retested 322 like support level here. Price did sideways, but today still form a lower low. So I think for now still looks like some weakness. We might see some continued lower lows to retest the next support area like 312 to 317 area for sets. Yeah, next one for Centurion. Yeah, it looks like some quite strong selling momentum recently. So back at now is about 144 over here. So I think price wise, we might still see some I think we might still see some weakness down because the weekly chart also below the 20 MA level as well. And for now, yeah, we might see price kind of retest maybe 135 to 140 area, maybe. Yeah, wait for the momentum to cool down first. And next one for WeHer. For WeHer, I think also some price weakness today because price was before that was in this consolidation phase, and then some weakness was that traded below the short-term moving averages. And then another one today was breakdown to this 71 cents level to fill out this gap, 68 cents. So here my hold as a bit of support 67 to 68 cents, but I think will be a bit of a weak rebound. 70 to 71 cents will likely be resistance. Then price might, if here cannot hold, then price might continue to come down towards like the 64, 65 cents area again. Yeah. Let me see what's the other questions. Okay, next one on Boeing and Caterpillar. For Boeing, I think generally this counter is a range bound trend for now. Then the resistance is generally 240 onwards. So some pullback from resistance area, and then also breakdown of this 235 level as and then some of the moving averages as well. So some selling recently. So I think you might see some support generally for now, some levels like 220 as well as 216. So let's see where price can stabilize. Then next one is at 211, this gap over here. So we're back. Yeah, so could come back to these levels over here, then maybe do some sideways a bit again. Yeah, for Caterpillar, overall still in a uptrend. Yeah, then not near term wise, I think near term wise, most likely some sideways, some slight weakness for now as after this earnings gap up, price consolidated over here with support at this 895 level above this swing high resistance, and then but some lower highs, and then Friday there was a breakdown below the 5 and 10 SMAs with a breakdown below this support as well. So I think we could see some slight pullback for now to test this 69, the 20 MA level. Then could do some rebound sideways again. The next one on some ETFs, VTI, which is a Vanguard Total Stock Market ETF. Okay, I think not sure what this trades, but I think the price action is, I mean, in terms from what I look, the price is kind of similar to S&P 500. So I think for my take will be somewhat similar to the S&P, some with a potential bearish reversal in the short term with this above the 365 level. So short term wise, we might see some pullback. If this 10 MA feels to go like 362, then we might see some retest of the 359, 357 to 359 area over here again for some supports. And to close, there's also a gap over here in the 20 SMA level. And next one is the Hong Kong Exchange 3010, this iShares Core MSCI Asia X Japan ETF. Yeah, for this, I think yeah, in terms of the candlesticks is quite a bit messy lah. So not, I think in terms of TA might not be that accurate, but for now in general the trend is still an uptrend. Then yeah, for now I think we could see some pullback from the recent area. It's $89, $90 for now. Then short term support I think will be this 85 level over here. Then I think price most likely could do some sideways first. The next one, VOO, yeah, similar to the S&P 500 ETF. So I think, yeah, so I think most likely also see some pullback. It feels to hold 675, 676. Near-term support levels is around 666 to about 671 area. And then for next one, Hua Tiong Global. Yeah, for Hua Tiong, I think price is still pretty much range bound since the rally took place from January, February. Price has been quite range bound. Then recently, after this strong volume day, also pretty range bound, but some slight weakness when recently was the breakdown of this some moving averages as well as the support over here around 84, 85 cent area. So I think we could see some slight weakness for now. The next strong support is around this 79 cents level over here. So price could do a retest of this level over here. Then resistance we could see in the short term from the 85 cents area. So I think, but overall, I think we still hold this range for Hua Tiong. I think it's about 1 o'clock. Sorry, we are able to take all the questions. I think there's still quite a few more in the chat. But yeah, feel free to post this on our Poem 3 community, then we'll answer it over there. Yeah, then also apologies, a few of our colleagues are away today, so I will take some of their questions related to their stocks. So I think on behalf of my team, I'd like to thank everyone for joining in our webinar today and for all your questions. And this week, in terms of our corporate insight webinar, we have Centurion as well as Oxbay. So if you're interested to find out more, feel free to register and dial in for the webinars. Yeah. So thanks everyone, and hope to see you again next week. Have a good week. Bye bye.